Hi, in this video, I'm going to talk about capital gain and loss lending process. So no matter when you invest in the stocks or real estate or business property, whatever, so then when you have a capital gain, which you can be a long-term capital gain, which is greater than 1 year, then can be a short-term capital gain is holding period is less a year. So then you have capital gain, capital loss, long-term and short-term. Capital gain, within the capital gain, you have a regular capital gain taxed at a 0%, 15%, and a 20% tax rate. Then you have a depreciatory capital gain. That's called Section 1250. Property is taxed at a 25% tax rate. Then you have a collectibles. So if you invest in the gold or you invest in arts, invest in baseball cards, so those things, if you have a gain, so then you will tax at 28%. By the way, if you invest in gold ETF, so if you have any gain in that, you will be taxed at 28% rather than the regular, 20%. So that's something you need to know. However, those it's not just a simple you tax on the gain, you deduct the loss. You have to let the gain and the loss together, then to produce the final gain or loss. So here, let's look at it. The reporting of the taxpayers' capital gain and losses is done on the Schedule D IS Form 1040. Under this schedule, the following rules for the capital gains lending procedure are implemented. Short-term capital gain and short-term capital loss are lending against each other. Long-term capital gain and long-term capital losses are lending against each other. So if any gains and losses remains, whatever their character, they are again lended. If the capital or loss remain after lending, only $3,000, then $1,500 for taxpayer merit file separately. All the lending loss may be used for offset the ordinary income in any 1 year. So when there are both unused short-term capital loss and long-term capital loss, the short-term losses are used first, and the remaining losses are carried forward, which is good news because short-term loss are taxed at an ordinary income rate, so you can reduce your ordinary income, right? So example here say if after letting all the short-term gain and the losses and all the long-term gain and losses, the taxpayer has both let short-term capital loss $4,000 and the long-term capital loss $3,000. The taxpayer uses the $3,000 unless file merit separately. Observe short-term capital loss in current tax year and carry forward $1,000 short-term capital loss and a $3,000 long-term capital loss. All gains and losses are grouped into several categories. First is short-term gains and losses in one group. Long-term gains and losses are grouped according to their respective group and bucket. For regular, your long-term capital gain and losses is 15-20% group. Then you have a Section 1250 group is 25% group, right? Then the collectibles like gold, silver, your arts is 28% tax rate group. So gain and losses are first lending within their own rate group. Collectible losses against collectible gains and so on to arrive at a net figure for that group. Capital gain and losses lending process. So the capital loss is generally deducted against the gain that would be taxed at the highest rate. A less short-term capital loss is applied first to reduce a less long-term gain from the 28% group, then reduce it from the 28% group, then finally to reduce the net gain from the 15-20 group. So you can see here, this is kind of beneficial for taxpayers. So basically say if you have a less short-term capital loss, you would reduce the 20. See, if you have a gain from, you selling gold ETFs, so that gain usually will be taxed at 28%. However, if you have a short capital loss, if you have any loss, gonna reduce that group again first. Then that group again exhausted, then go to reduce the 25% depreciation recapture group. Then go to reduce your 15-20%, the lowest regular capital gain group. So this is great for taxpayer. Actually, it's more beneficial, right? Then say a net loss from the 28% group is used first to reduce the higher one. 25% group, then reduce the net from the 15-20% group. The net loss from the 15-20 group then is used to reduce the net gain from the 28% group first, then reduce again from the 25% group. Any resulting net capital gain is taxed at the group's marginal tax rate. So let's see an example. See here, say Murray, a single taxpayer, completed several security transactions in this year 2020, generated the following capital gain and losses. Long-term capital gain is 6,000. Long-term capital loss is 5,000. So they're gonna let together. So long-term capital gain reduce long-term capital loss reduce long-term capital gain. So you have a long-term capital gain $1,000. Short-term capital gain is 3,000. Short-term capital loss 8,000. So you will result a short-term capital loss is 5,000. Then 5,000 capital short-term capital loss will let against the $1,000 long-term capital gain. So you'll result a $4,000 short-term capital loss. So this short-term capital loss, you only allow deduct $3,000 from your ordinary income, like your salary income, right? You only use it to deduct for $3,000. Then the rest of the $1,000 you're gonna carry forward to next year to deduct your income. So that's the entire letting process for the capital gain, capital losses.